Is it recording or not? Okay, perfect. And now I'll share my screen. Please let me know if you can see my screen just fine. Okay, it should be sharing now. Can you see the introductory slide for the presentation?
Yes.
Yes.
Amazing, thank you. So there's a second thing I wanted to point out before. Amazing, someone is still joining. Good to know that it works this way as well. Okay, there's one thing I would like to point out before I begin with an introduction or anything, and that is the fact that we will be using Slido today. It won't be for polls or any quizzes or something like that. You don't have to be afraid of that. But it's a great channel for asking questions. So please, if you could just go to the website of Slido, I think it's slide.do or slido.com. I think both of those will work. Yeah, just type slide.do into your internet browser, ideally on your mobile phone, and enter the code that you can see on the screen. So just enter 6333281 into the first text field that you see there. Let me do the same to see if it works fine. Yeah, works fine. So the thing you will see after using that code to log into to our meeting, or let's say to our event on Slido, is a Q&A window. So there is a text field which says type your question, and you can type your questions there. They are anonymous, so no one will know, the name and surname of the person who asked. We prefer to do it that way in case you want to ask even more personal questions based on personal experience and anything regarding or related to the things that we will be discussing throughout the presentation. So whenever you have a question, please don't be afraid to ask it via this channel to submit. If you want, you can already start asking questions there. I will have it open, so in case it's strongly related to the slide that is currently being presented, I will try to answer that immediately as I'm covering that slide. But feel free to ask also questions that are not related to clarifications of a certain slide or anything else, because at the end I have a Q&A slide, and I will be happy if we can have an extended discussion session related to your questions, maybe about personal finance in general, maybe about some topics that weren't covered directly at this presentation. So there will be a lengthy Q&A section at the end, and I will answer all the questions that you submit throughout the presentations during that session. I can already see that there is a question whether I can send the recording to you as well. Of course, the recording, if I understand the process correctly, will be sent to your HR department so that they can publish it on your company's internal channels. So all of you who are here will also have access to the recording, so that you can either finish watching the parts that you can't do today, or rewatch some parts in case you would like to see them a couple of times. We've had many people, do that in the past. So you will definitely have access to the recording. Thanks for the question, and feel free to submit similar questions or questions related to the topic throughout the presentation. We will go through them. Okay, in that case, let me know if there is any emergency due to which I have to defer the start. But if not, I would get to it so that we don't end too late and so that you can go enjoy your lunch afterwards. So welcome everyone, and thank you for joining for today's session. My name is Šimon Pekar. I will introduce myself in more detail after this introductory slide. I work for the company Finax, and one of the things we do is provide education related to investing and related to personal finance. And a part of that education are these presentations, these webinars or interactive sessions that we like to go organize in companies. And the topic of today's session will be emergency fund and investing. So we will be looking in the first part of the presentation at a very important reason for why creation of savings and creation of some forms of wealth is important in life, and that is to cover emergencies. And then we'll look at, in the second part of the presentation, and the main part of the presentation, at how we can work with savings that we have already created in our lives once we have them, how we can appreciate them via investing. So there's this Slido code. Please, I hope everyone was able to use it now. If not, tell me throughout the presentation and I can come back to it. So before I delve to the specific topic, into the specific topic, let me tell you a bit about myself so that you have a better idea of who I am and what I do in my life. I work as a financial analyst in a company called Finax. We were originally established in Slovakia, and we are essentially a provider of managed investment portfolios. So that is essentially a securities broker dealer. You can call us. I work in this company as an analyst. So throughout my both academic studies and working career, I've worked with financial markets, with investing, with economics, with finance-related topics. The last 3 years I spent in Finax. Things I cover is usually related to external communication, which includes organizing webinars, organizing lectures such as this one. I also do a lot of analytical work. I have been involved with project management related to managing and launching new products recently. And very recently, I also started to work with company finances and get engaged in that. So I have some experience related to both number work and communication work related to these matters. Before that, I worked as a journalist in a publication that covers business and economics in Slovakia. And I've been interested in economics even at high school already. It's been going with me and sticking with me for many years. I won several national economics competitions back in Slovakia. Regarding the academia, I studied at the University of Amsterdam. I also spent a semester at the University of Hong Kong during my studies, studying economics and later focusing on finance in my later years of studies. And another thing is that I'm also sitting in the investment committee of our company, so I, get some insights into how investments and products related to that work. So I will try to use this experience to tell you in simple language something about investing, savings, all those topics that I'm interested in. Okay, so with that in mind, let's introduce also this topic and the reason why we chose this topic. This lecture that you will be seeing today is a part of a broader program that we as Finax, that is the company I work for, developed. So we created this program called Financial Wellness that we usually present in the form of lectures similar to this one. Sorry, is there a question? Or was that just accidentally unmuted mic?
Sorry. I was talking to my husband and I did
No
know
worries,
that
no
I
worries.
am not on mute, so sorry.
No worries. Happens to me as well all the time. Just check whether your microphones are muted, but no worries. Okay, but if there is a question, feel free to also, raise it vocally. If you're not shy, we can discuss it also live, not just through Slido. Okay, so this program you're seeing is so-called Finax Financial Wellness. It's a series of lectures that we develop that we usually grant to companies, and it's sort of a brief, not so brief. The lectures are long, but summary of the very basic things of our philosophy related to personal finance and investing. We have been trying to push a lot of educational activities that are usually accessible for free. So we do a lot of podcasts, blogs, webinars, and similar things where we discuss not just things related to our products, but also things related to finance and personal finance, budgeting, how to save on different expenses, and all the topics that really common people have to deal with oftentimes. And we try to be active in this via this content regularly. We also created a textbook for high schoolers, and these lectures contain a summary of that philosophy, a summary of those findings that we have, came at or concluded throughout our lives and professional experience, and also throughout creating that content. So you will be seeing the second lecture today. The first lecture is usually related to healthy personal finance basics. So that includes all about setting up a budget, analyzing your personal financial situation, how should your budget develop over life, how to prioritize expenses, and what even are the basic reasons why caring about personal finance is important, and what are all the life areas it can help you with. Afterwards comes this lecture that you will be seeing today. That is related already to a bit more advanced topic of creating an emergency fund. So creating some first savings to cover unexpected emergencies, and investing. So working with your savings, letting your savings increase in value, multiplying them, and sort of growing them throughout your life, managing your savings. Then we also have a third topic, which is related to securing a comfortable retirement. So that one talks about all the opportunities that we have, all the threats that are related to state pension systems currently, and also all the opportunities that we can use to work with our retirement, increase it, and secure feelings of financial comfort and freedom rather than financial stress once we are in our golden years and we're too old or too tired to work and then be willing to work, right? Something that all of us probably want to enjoy and not stress about due to finance. So these are the three topics, and we will cover the second one today. So what is the exact more detailed content of today's lecture? We will start by discussing the emergency fund, what it is, why it matters, what you can use it for, and then we will look at optimal emergency fund parameters. That sounds a bit too, difficult language used, but all it says is, where you should hold your emergency fund, how risky should it be, where to store it so that you can get to it quickly, how quickly do you usually need to get to it, and how large should it be, how much should you even save for emergencies. All those questions will be covered there. And then we'll move to the investing part, to the main part of today. That will first of all discuss basic asset types. So assets are usually the things you can invest in. Things that you probably heard, such as stocks or bonds. We will look at them. We will look at what they are. We will look at how they differ from each other. Then we'll more in detail examine stocks and bonds, because despite there being many asset classes, these are the two most basic ones from which other ones often derive, and which are definitely the most widely popular in the global world of investing. And then we'll look at the difference between active and passive investing, and try to show you why it's no secret that we sort of prefer the passive investment approach, and we'll show you what it is and why we prefer it. And then we'll look at some more specific investment instruments, such as ETFs, which we love. We'll discuss their advantages, and we'll organize, the Q&A session. So feel free to ask throughout the Slido. We have a lot of time devoted to that at the end. Let's get right into the topic if everyone is comfortable. If not, please feel free to tell me. But with that in mind, let's get to the actual content. So why have an emergency fund? Let's start with that, because many people might even be asking whether creating some first savings is even important. So how can it help you if you have some amount of money devoted to emergencies? The first are things that you can probably think of very quickly, right? We can fall sick. That can either involve inability to work and be on a reduced salary that usually comes with a sickness that lasts for longer than a couple of days, or this can be related to job losses. So oftentimes we know people, and we've known people, and we've read about people who had stable jobs for years, but things can happen, especially if you work in the private sector. A crisis can come. We have seen the increasing energy, prices of energies and utilities over the last couple of years. So crises can happen, layoffs can happen, and you may find yourself struggling to find a job, or having to sort of survive a couple of months before you find a job. That usually comes with reduced income, right? There is some unemployment insurance, of course. There are some benefits from the state, but it's usually not as much as you earned before, right? So if you need higher expenses to support your family, support your kids, or to make fixed payments for housing, for food, for loans that you have, you might need some extra money on top of that. And that extra income for those couple of months while you're looking for a new job, for a good job, can help you draw supportive income, right? You can draw some supportive income to pay for the expenses that are needed from the emergency fund, which also helps you in a way that you don't have to rush the job finding process, right? You can actually spend a couple of weeks or a couple of months searching around so that you are fulfilled and satisfied with your with your new job, so that you don't have to take anything that comes first, even if you don't really like the company, even if you don't really like the conditions at which you are hired. You always have more leverage and more comfort and a bit more time when you have some savings from which you can draw income for a couple of weeks or months. Another reason where it can help with is it can serve as sort of insurance against misfortunes or any unexpected events that cost money, right? Think about your car breaking down. Think about households or your house or your flat needing a major repair because something related to water or gas stops working and you need to pay for it to have it fixed very quickly, heating, right? So all these things that can happen are easier to handle if you don't have to cover them from your salary and then struggle until the rest of the month. But if you have an emergency fund, you can just take out that amount from the emergency fund and over the next 2-3 months, just fill it back in instead of having to bear it with 1 month's salary and then struggle, right? Also, and now we're getting to the more reasons that are sort of less intuitive, but not less important than these two first intuitive answers. Another very important thing is wealth protection. Later on in this presentation, we will be talking about investing. We will be talking about long-term investing, so holding stocks for long periods of time. The reason we often have to hold investments such as stocks, which you might have heard of as being riskier than holding cash or holding maybe some bond funds, is that their value fluctuates. Stocks can decline, they can grow. They grow in most years, but they decline sharply in many years. And you might have heard, and you will, if you haven't heard, then we will show you the data and show you how stocks usually behave in towards the second part of this presentation, is that when they decline, um, usually the worst thing that you can do is panic and sell for that decline price because you will convert them into cash, which won't grow anymore. And you will sort of book a loss, right? You will sell them at a loss. So you bought them for, I don't know, a couple of €100. You will sell them at a lower price. So you will lose money on your investment. And you will usually miss the time when the stock market recovers again, right? So if we're talking about broad stock markets, so many stocks, holding many stocks, usually over the long run, but think 10, 20 years, so like a lifelong experience, they usually overcome every crisis and start growing again eventually. And you just have to wait for that patiently. The worst thing that can happen is, to panic and withdraw money at the bottom when they are the cheapest, when they are declined. And when you don't have an emergency fund and emergencies happen, you lose a job, you become sick, and you have to pay for extra treatment to get that sickness cured, or things like that, you might need money. You might be unable to cover that from your salary. And if you only hold investments devoted, for example, for your retirement, so money that you can use in that you want to or planned originally to use in 30 years, so you used riskier, investments that sort of fluctuate more every year, that decline and then grow more sharply. You might have to, withdraw that money from that investment account, sell those investments when a crisis hit and when it is at the bottom. And if you need to withdraw that money so that you can cover your sickness or cover your job loss, you might miss the market recovery and essentially lose money on your investment. So not having an emergency fund can push you to withdraw at times when it's not optimal to withdraw, because it's that time when you have to hold on to your investment and not let emotions control you, but you might be pushed to do the wrong decision. So having an emergency fund that can help you cover those emergencies also helps you invest in the long run and invest without letting your emotions or letting unfortunate circumstances take away your investment returns, take away your investment result. So this is also an important reason. Another reason we added after the recent crisis, because we thought it was a beautiful example of how emergency fund can help us. If inflation hits, right? And then usually wages don't respond that quickly. So you might find yourself paying more for energy prices, which happened in many countries over the last couple of years. If you have an emergency fund, you can use part of it to cover those increased costs until inflation declines or until wages catch on and start rising. Also, get adjusted at the end of the year or whatever. This also applies to higher loan payments. So we've seen interest rates skyrocket in the recent recent years. So mortgages that many people have and hold for most of their lives uh, are getting more expensive. Most people have fixations, right? But many of those fixations will cease to exist in either have already or will cease to exist in the next year, let's say. And then the monthly repayment amount can jump sharply. So that can be sort of an emergency that you can also partially cover from your emergency fund until you find a more long-term solution to sort of cover those costs. So anything unexpected like that can be covered via the fund. And then last thing, and one of my most favorite things about this list, I would say even a favorite, is that an advantage of emergency fund is that even if no misfortune happens to you, even if you believe that uh, you will just be a lucky person, that still doesn't mean that it won't help you in your life because it can help you seize opportunities comfortably. You will probably agree with me if I say to you that if you have some amount of money and you know you're covered and your kids are covered and your loved ones are covered and your debt repayments are covered for at least a couple of months, then it's sort of easier to take risks in life. Think about having an opportunity to start a business later on because you have a great idea, or to switch employment because you're just not satisfied with your current job and you would like to move elsewhere under better conditions. But you know that that will require a transitionary period where you might not have an income. It's a risk. If you know you will be covered, even if you lose your job and look for a new one for the next 3 months because you have a large emergency fund, then you can seize this opportunity and maybe that can help you land your dream job with better pay, with better conditions, with better colleagues, with better fulfillment in your life, right? Same applies to business. Same applies to maybe investment opportunities when the markets decline and you want to invest a larger amount because you know that in the long run markets usually recover and it is an opportunity to buy stocks cheaply, for example. So all these opportunities are easier to seize. It is easier to risk in your lives if you have the emotional comfort that your loved ones are covered. And that is what an emergency fund is for. Now that I hope I convinced you it can be helpful, you might be asking, what is the target even? How much money are we talking about here? Uh, I won't give you a formula because personal finance are called personal finance for a reason. They are personal, they are individual. Every one of us has different life situation. We have different people who depend on us. Some of us live as single people. Some of us have kids to take care of. We have different priorities. Some of us might be happier spending things or spending money on different things than others, and that is completely fine. So generally in personal finance, it's good to communicate with people around you. It's good to be honest with yourself and sort of find things that work for you. So even the optimal emergency fund will differ based on your situation. However, we think there is a general guideline to follow, and that is to look at your income type, because different income types yield different levels of risk. We would say that the least risky are state employees, because in the state sector, we don't often see mass layoffs because state is usually covered with taxes, so has sort of a guaranteed income. Whereas compare that to private sector, where companies, if their products stop selling, and competition pushes them out, they just won't have money. They can't tax people forcibly and force them to have income. So things such as layoffs and reducing the number of employees are much more common in private sector than in among state employees. So if you work in private sector, you should have a bit more money in your emergency fund than state employee. However, the highest risk is involved among self-employed individuals or individuals who have a highly variable income because they operate some sort of a business with non-guaranteed monthly income and non-guaranteed benefits, right? These people can earn a lot of money in some months and then earn nothing in the following 3 months. They have some sort of, seasonality in their incomes. So those people definitely need the largest emergency funds because they literally need to be able to cover those months where they will be earning minimum money and then, fill that money back in when they have their strong months of the year when their business thrives. So depending on the income type, you should sort of adjust this. There is a formula that I'm going to share with you that usually works. What is usually recommended is to save up 3 to 6 months of your monthly expenses. The rationale behind this is that you need to be able to live off your emergency fund without any other income, at least for a couple of months. Remember, we were talking about job loss. We were talking about sickness and inability to work for maybe couple of months or even a year. We were talking about seizing opportunities when you're, starting your business. You might be not be earning a lot of income for the first couple of months. So having at least a couple of months of expenses covered is important. So expenses usually involves mainly the mandatory expenses, the required ones that you have to pay, right? So sit down with your partner or sit down with yourself if you live without a partner and without kids, and try to, sum up your loan repayments, sum up how much your housing costs, how much you need to pay for food, how much you need to pay for school, and similar things for transport to get to your work, or get anywhere you need to be if the emergency is a job loss, right? So sum up these things and ideally multiply that number by 3 or 6, and your optimal emergency fund should lie somewhere between those margins. When you're a self-employed person or a business owner, that will be at least 6, maybe even slightly more. When you're a state employee, maybe 3 is enough. For private sector, somewhere in between, a number which makes you feel safe, a number which makes you feel comfortable, because it's also important how you view this personally, emotionally. Okay, and now after we have the target amount and we try to save it up, then you might ask the last thing: where to store this? Where is it optimal to hold this money? Should I just leave it in my bank account, or do people usually use something else? I definitely do not recommend to hold it in a current account. So definitely not the one where you have your other money for spending, right? Just your regular bank account, because you would have a tendency to spend this. You need to separate this money, because if you mix it with your in the account where your salary, where your paycheck, where your other income comes every month, you will have a tendency to spend it, for the simple reason that either you might do it accidentally because the money mixes and you just make an expensive purchase without realizing that you didn't have money for that if you subtracted the emergency fund anymore. But it's also tempting, if you have it very easily accessible in your bank account, then you're out with your friends and you say to yourself that it won't hurt anyone to spend 30 euros from that emergency fund. You will fill it in after your next paycheck arrives, and then you don't do it because there's another, 30 euro expense that you want to cover from it in the next month. And by this logic, you know these little decisions, but if you keep doing them over a year, your emergency fund might be gone and disappear. But there are also two more reasons why we do not recommend current bank accounts, and that is zero return. You probably know that despite hearing about expensive mortgages everywhere around you, your either current or saving account in a regular large bank is not yielding much interest. Definitely not the 4% we are hearing about from the news that the European Central Bank has already pushed interest to those margin. Um, oh, uh, there is a question in Slido, so I will address it now because it relates to the previous slide. So sorry for making the abrupt shift, but let's deal with it now. How many salaries or how many expenses are recommended to have as a reserve in case you have a mortgage? Um, I have never heard of a specific formula for this, but I would be cautious, right? Because that's again, if you have debt, so if you have more debt that you have to pay, you would want to be a bit more cautious compared to people who don't have any debt payments, right? Those people will need a lower emergency fund. But definitely, what is an important point here is that a mortgage, so mortgage repayments, are considered to be your expenses, right? So when you're computing those monthly salaries, 3 to 6 times monthly salaries or 3 to 6 times monthly expenses, definitely count in the mortgage, so that at least for 3 or 4 or 5 months you are capable of making this mortgage payment solely from the emergency fund, right? So by taking each month, taking that money from emergency fund and paying for it. But usually the recommendation of 3 to 6, so somewhere in between that, is already counting with that those people hold mortgages, because that's usually the standard situation for people to whom this is. So if you count in the mortgage payments into those expenses and have like 4 or 5, I think that's fine. I think you're covered. Because I know it sounds scary, but usually when two big crises happen, The banks are also turning out helpful, right? So when there was COVID, you could ask for postponement of mortgage repayments. So if there is like a general catastrophe, then banks will probably start cooperating. But yeah, let's say 3 to 6. Maybe I would go for four or five at minimum, but that already counts with mortgages. Okay, let's get back to these where to hold the money, right? So apart from tendency to spend, you also don't have high interest rates in current accounts or even in savings accounts. Mostly, just check with your bank. I would bet that it's not very optimal with most of the people who are present here. So you won't be earning any return. You won't be increasing the value of the savings, or at least earning some interest on them. And that leads to the fact that inflation will slowly eat away its value. I don't think that after the last couple of years I have to introduce the inflation much. It's in general, it's the fact that over the years, on average, prices tend to rise. Everyone knows that prices were lower 10 or 20 years ago compared to how they are now. So that means that each euro in your emergency fund will buy less and less goods or services or things in general, as you hold it. And emergency fund is something you should hold throughout your life. So if you have 5,000 euros today, that might have a completely different purchasing power now compared to how well it will cover you against expenses that you might incur in 10 or 20 years. So in order to not to have to deal with it, right, to recalculate and reconsider your emergency fund every year and maybe increase it by saving up some extra amounts, it's the best to earn some interest and some adequate interest on it, and to try to beat inflation with it so that it covers you equally well throughout your life. That would be the optimal situation. And that leads me to the question of how should an emergency fund look like, right? What you should think about when you're deciding on the destination for that money. So the first word is liquid. This word sounds technical, but it's an easy concept. A liquid amount of money is an amount of money that you can access quickly. That is, you can have it in your bank account, ready to send it somewhere or pay with it with your card that your bank has given you quickly and without losing much of that money, right? So, in other words, this says that your emergency fund should be accessible. Some emergencies need to be paid for quickly. I've had my experience at an airport where for a sad reason and a misunderstanding, new flight tickets had to be bought immediately for us not to get stranded somewhere. So some of that money needs to be so that money needs to be accessible. A portion of that money needs to be accessible immediately. So ideally, a portion of that emergency fund should be in your savings account so that you can transfer it from that savings account immediately in case something bad happens and needs to be dealt with now. And the rest of that money should be accessible within a couple of days, right? So if you have a job loss, you can wait for that money for a couple of days, but then after a couple of days, it should be ready to be spent. So it shouldn't be tied up in investments such as real estate funds, which from time to time can restrict withdrawals from their funds if some of them have this condition, and then it can take more than a couple of days to access this money, and that can be a problem if you really need it. Another parameter is that it should have low risk. You shouldn't take much risks with this money. There will be other types of money that you will have for goals such as retirement, which you will use in 20, 30, 40 years, maybe 10 for some people, or 5. But for many people, that's decades, in decades, that will be needed in decades. With that money, you can take risks. With money that you need for emergencies, need to cover you and your loved ones, you shouldn't take many risks, because if the investment declines and loses 30% of its value and an emergency comes, you don't have that money. You can't use it to cover the emergency, right? So although you can take some risks to beat inflation, not too much. It shouldn't be possible for this money to decline by sharp amounts. I've once had a client tell me that uh, they held their emergency fund in cryptocurrencies, and it was very, very closely before the most cryptocurrencies lost between 2/3 and 90% of their value or 100% of their value. And it was exactly during the crisis when it was more likely that the money was needed. So with 2/3 of that money gone, that's not having you covered much. And then also beats inflation for the reasons that I have already explained. So usually what we recommend to people is looking at a high interest or at a savings account with at least some interest. There are banks that have higher interests. There are banks like, for example, Revolut has a good saving account. It is paying out good interest. So usually a portion of that in a savings account so that it can be accessible immediately for payments. Let's say if you have 5 monthly expenses in your emergency fund, you can hold 2 of those in your savings account, and then the rest to beat inflation. We usually recommend to invest it with low risk. So there are many low risk investments currently. There are funds that so-called money market funds, which sort of replicate the central bank high interest rates that are currently present in the market, or some bond funds, or some mixed portfolios that mix stocks with bonds and similar things. Because these portfolios do not have very high risks. They invest mostly in assets that are not as risky as stocks, but also on average, if you hold them for 10 years or something, tend to beat inflation and increase the value of your investments. But they're careful that there will be some risks involved with that. So you can research those options, and that is essentially how we usually do it. So that is what we usually tell people. Okay, let's move on to the second part of today's presentation, and that is investing. So as we explained, one of the reasons why I have an emergency fund that doesn't have much risk, a portion of which is in literally a savings account, is for you to be able to take risks with other money. So to be able to use other money that you will be investing throughout your life for very, very unimaginably long periods in many cases. Um, Yeah. There is a question in Slido, but I think this is one of those types of questions that I would defer to the discussion at the end of the presentation. So if it's no problem with you, I would, discuss this at the end because I think it will be nicely tied to some of the topics that I will be covering later on in the presentation. So the next couple of slides might partially answer it, and then we can add the rest at the end, not to sort of repeat myself when I come to those slides. But yeah, thank you for the question. Thanks for asking. I'm really happy that you have questions about it and that we have content for the final discussion. So, one of the reasons, as I said, one of the reasons why I have an emergency fund is to be able to take risks and stick without withdrawing money from investments that you will be holding throughout your life. So let's delve into this. Before we get to any strategies, before we get to any investing, let's discuss what even investing is. Investing is placing savings at some investment tools or investment products or investment vehicles with the goal of earning a profit on that money. So today I invest 1,000 euros, and in 10 years I am expecting to have more than 1,000 euros, to have multiplied that money, grown the amount of that money, let it appreciate in value. That is investing. And we do it by purchasing so-called assets. So assets are things that generate profits. They are things we can invest in. There are 3 basic types of assets we can invest in. The first of them are stocks. You definitely heard what stocks are, or heard the name stocks, but what are stocks? Stocks represent ownership stakes in companies. Whenever you buy a stock of a company, you own a portion of it. What does ownership mean? Ownership means that you have a right to participate in a portion of profits. So whenever a company is paying out profits to its owners, you have to participate in that, right? And that can come in 2 forms. So income, profit from stocks is generated based on 2 things. Either very explicitly in the forms of dividends. Dividends are payments that company makes to its owners. So from time to time, a company has cash and doesn't see any way in which it can invest it. So it distributes a portion of that profit to its investors by paying it out based on who owns the stocks. So dividend payments are made to anyone who owns stock, and that is one form of profit earned on stocks. Another is so-called capital gains. This just means that the price of stock increases. Whenever company is growing, makes profit, and analysts somewhere on Wall Street or in London are optimistic about how this company is doing, they will be willing to pay more for the right to participate in the profits and in the growth and in the success of this company. So the price of its stock will increase, and anyone who bought that stock at a lower price will be able to sell it at a higher price. However, with the right to participate in profits comes a downside. Just like owners are participating in the successes of companies, they are also participating in its falls. And so whenever the company is not selling its products well, whenever its profits are declining, stock prices will go down and you will lose as an owner. You will, suddenly have stocks that are worth less than they were when you purchased them. And the worst thing that can happen to a company is a bankruptcy. So that means that it was unable to pay its debt, that it's basically ended. It's going bankrupt. The company crashed. In that case, debt holders, so those to whom the company owes money, those who lent it money in the past, have the right to seize control of this company, so push out owners, and they have the right to sell its assets or continue operating it and claim money that the company generates. So they can, for example, sell off its property, they can sell off its computers, buildings, everything, machines, patents, and similar things. And all the money that is earned, debt holders can use to compensate a portion of a loss. Only after all the debt has been settled by selling off the company's property, only then the owners, the stockholders, can come in and use whatever is left after debt holders to cover their loss. So in case there is a bankruptcy, debt holders, people who lend to companies, have a higher priority, so they can first get their claims compensated from selling off the company property before stockholders do. And that is why stocks are involved with higher risks. Compared to that, and we will talk about what that means later. Compared to that, bonds are types of investments which are just loans packaged in a security, right? Loans packaged on paper, right? When you buy a bond, you are lending money to the company. And whenever a company borrows money in this way, it promises to make fixed payments to the people who own its bonds, so to the people who lend money to it, in the form of interest payments or coupon payments, and then later repay the borrowed amount, right? So whenever you buy a bond, you get a promise of getting fixed interest payments. And then at the end, if you hold it until it matures, every bond has sort of maturity. Think of it like when you borrow through a mortgage, you have it for a set number of years, right? The same when you borrow through bond. So after the maturity, a larger repayment of the borrowed value is coming. So income in this comes from these interest payments and from the final repayment. What is great about bonds, or what is an advantage, is that, or it's both an advantage and a disadvantage. These payments are fixed, so you know them in advance. It doesn't depend on profit, which is unknown, which can be an advantage if the company is struggling, because it usually tries to at least repay its loans despite earning low profits. So stocks can go down while bonds make their payments. But it can also be a disadvantage, because if the company succeeds and thrives, then there is a ceiling on how much you can earn with bonds, because it's a fixed amount, and all the profit on top of that comes to stockholders. And as I said, bondholders also have a higher priority in case a company comes bankrupt. So you can sort of see that these bonds have a lower expected return because they don't participate in the success fully. There's a ceiling on their income. However, they have much lower risks than stocks, because you don't bear, you don't have to suffer if the company is not selling as well, or grows more slowly than expected, or in case a bankruptcy happens, you get more money than stockholders. So the risks involved are a bit lower. And then the third class are alternative investments. Those are any investments that are outside of the stock and bond markets, called alternative because stock and bond markets are the largest, the most well-developed, and the most well-regulated by the states. Any alternative investments are outside of these traditional, large, well-developed, and well-regulated markets. And that can be anything from real estate, whether you own real estate funds or whether you have investment properties which you rent out to some people. They can be commodities, they can be precious metals, they can be coffee coffee grains, they can be cryptocurrencies, whatever you can imagine. And income on these usually comes from changes in prices. It can come from rent if you own an investment property, and anything like that. Now, I have already mentioned that there is a certain relationship between risk and return. Return is how much you can earn on this investment. And how that is usually computed is that we have a lot of years of data, right? We can look at how these things such as bonds, stocks, how real estate, how those prices developed over last 100 and in many countries even 200 years, right? And we can sort of look at how much they tend to grow on average and how stable this is. So, as I already said, stocks, because you have a direct participation in profits, you get a participation and fully benefit from economic growth in the long run, right? So, think about the new inventions, think about increasing productivity, things like that. Usually, stocks over the last 100 to 200 years tended to grow more than bonds, whereas bonds tended to grow a little less. The least growing asset, so the lowest potential return, is earned on cash because cash oftentimes doesn't even yield interest. And if it does, the interest is relatively low. Just try to now imagine how much you are getting in your just current account, or if you hold, physical cash. So if you withdraw a 20 euro banknote, you're not getting any interest whatsoever on that. So cash usually doesn't earn nothing or just earns a little interest, but it's the least risky, right? And then as you move to things like bonds, the return increases, then real estate, then stocks, and then some alternative investments are very risky but can earn a little more than even stocks. Um, in contrast, expected risk is how stable the value of this investment is, right? So risk in finance is usually computed as the degree to which it is unstable. So when you have a risky investment, the value of this investment will fluctuate sharply. It will grow sharply in some years, but it will fall sharply in other years. And also the expected risk is the depth of declines, right? So when we say an investment is riskier compared to some other investment, then the safer, less risky investment, let's say, can usually, or the worst that's happened in its history is that it declined by 20%, whereas the worst that has happened to a riskier investment is that it's declined by 60%, like a deeper fall down that can happen, right? So there is this relationship that usually in finance, things that are less risky earn lower returns, and things that are riskier earn higher returns, especially if you hold them over long periods, right? Things like stocks or alternative investments definitely don't have to grow each year. That is false, and we will later see why. I will show you graphs of how it usually looks and everything. But this relationship usually holds that whenever risk is higher, investors in general would not hold these assets because no one likes risk. Who likes to risk with their money? Unless these investments can offer them a higher return potential. So there is usually this relationship that higher risk usually comes with higher return. What is important is that oftentimes you can mix these different types of assets to achieve the risk that you want. So that is what my next slide is about. We often mix stocks and bonds in portfolios, right? We hold both stocks and both bonds, and we hold some portion of our money in both in order to adjust the risk, right? So when you have a stock portfolio and you add bonds, they decrease the risk because bonds are less risky. They fluctuate less sharply, they decline less deeply. So they are, in general, serve to reduce a risk of portfolio. As I said, they have fixed return, they have fixed time to maturity, so they are easier to predict than stocks. They add predictability to the portfolio when you add them. And they also, this is again a statistical term, but don't worry, I will explain it. They also usually have lower negative correlations with risky asset. What does this mean? It it is just the idea that when a crisis hits and things such as stocks tend to decline, usually what happens to bonds, especially safe bonds, such as those ones issued by governments, which, even governments can go bankrupt. We remember Greece, but many larger governments, such as, I think, Netherlands, it's very difficult to see how they would ever go bankrupt, especially since they have taxes, and if there's a problem, they can just increase them. So usually these assets that are considered safe, investors shift to them in times of crisis and their prices increase. So oftentimes what happens when stocks decline, bonds, especially government bonds, rise a bit. And this sort of saves you from deep declines because while a part of your portfolio is declining, another part of your portfolio might be growing a bit and sort of reducing the total decline that you experience. So adding bonds into portfolios also serves to make, the potential declines a little less deep, a little more shallow. And as I said, so it makes the portfolio fluctuate less sharply, and it's suitable, especially, you might be asking when we need this, and we need that especially if we're investing for shorter periods of time. As I said, and I will explain on the next slide, if you have a longer horizon, so you need that money in 20 or 30 years, that is when you can afford to take higher risks because whatever happens, a crisis hits, energy prices increase for a couple of years or whatever. If you have 20 or 30 years before your retirement or whatever, you just can wait until that crisis recovers. And every crisis has been overcome in the history of humanity. And then stocks start growing again, right? But what you need is that time. That is the essential precondition that you need. You need to be able to afford to wait for a couple of years if a decline happens. And if you don't have that time, if you don't have the luxury of the time, then you can't afford to take too large risks. And you usually add bonds or cash into your portfolio to decrease its risk. But okay, one more slide before we get to the long run risk and long run investing. It's also important, when I'm talking about bonds or cash in the previous slide, the so-called defensive assets. Even there, you should be cautious where you hold it, right? Because you definitely have heard that due to the inflation, interest rates have been increased a lot over the last couple of years. So currently, right now, they are at the level you see in the graph. They are still at the level of 4%. That is the rate that the European Central Bank set. But this rate isn't accessible directly to common people like us. This is a rate they set for commercial banks to force them to increase their own interest rates. However, this doesn't perfectly translate to the products that are accessible to us, right? So you know that in your current accounts or in your savings account, you probably don't see 4%, right? So even when you're selecting a defensive asset, so a place where to hold things similar to cash or bonds to buy, you need to be careful so that your interest isn't too low, right? So that you don't get, I don't want to use a bad term, but so that, the bank doesn't earn money on this. So, even when researching these things, it's important to look at what the interest rate is whether it's high. And there are great options on the market. You just have to spend a couple of minutes researching. So there are high interest savings accounts. Some of the time deposits in banks, if you can tie up the money for 2 years without withdrawing it, already offer large interest rates. But there it often comes with taxes, for example. So be careful about the interest taxes. And there might be other options that have tax advantages, right? So, for example, there are money market mutual funds. Money market is usually the term that we use for investments that essentially try to replicate this central bank interest rate, that invest in very, very short-term safe bonds that usually pay out interest rates similar to time deposits in banks or similar to savings accounts, high interest savings accounts. So some time deposits are good, but also you might have money market mutual funds. You might have money market ETF funds, ETFs, which are also great investment vehicles similar to mutual funds, which pay out large interest rates, or much higher than some interest rates in normal banks. So you should be aware of these options, and some of those, such as some mutual funds or ETFs, might even come with tax advantages. So you might avoid paying the interest rate tax that you usually have to pay on time deposits or on savings accounts that the bank automatically withholds, right? So you can look into those options, but even on bonds, even on cash, even on money that you hold for the short run as an emergency fund or as money that you will need soon and can't afford to tie it up in a stock investment for 10 years or 20, 30, then even that money should be handled carefully and researched whether the interest rate you will be getting on it is adequate given the 4% interest rate that the central bank has set, and that you would get charged if you took a mortgage, or you would get charged even much more if you took a car loan or similar to that. So careful about that, but there are good products. And now let's get to the long-term investing, right? So I said several times during this presentation that if you invest for longer periods, so if you invest for more than 10 years, usually, and that means that you can afford not to look at that money and even think about it for 10 years, right? At least ideally even more, then stocks are usually the best investment. Why so? In this graph, you can see average returns earned over, you can see almost a 100-year period. So average annual returns means that they just compare the value today compared to how it was 100 years ago, and compute, the average. So how much it on average earned or grew every year. This doesn't mean that it had to achieve exactly this number every year. It's likely that it grew by 30% in year one and then declined by 10% in the other year. But this is the average number that you get if you hold it and don't touch it for this insanely long period of time, right? What is important to note is that these aren't some specific stocks or bonds. These are things that represent the entire stock, bond, gold, or real estate market. So they usually took a portfolio that holds a lot of stocks, that holds hundreds or even thousands of stocks that can be found around the world, that holds many bonds issued by many different issuers. So you sort of have many, many companies. You sort of have the entire economy included in these portfolios, or at least most of the economy. So most of the different companies, most of the different sectors, and similar things, right? So these numbers represent growth of, if you hold many, many stocks, many, many bonds, many, many different houses in your real estate portfolio, right? So that is another important point to make, that this is not tied to, I don't know, Microsoft or some specific company that you can imagine. This is tied to holding hundreds of these things to sort of get some average, right? Get some average idea of what the average stock does. And you can see that inflation is here at 2.9%. That is usually the number. Usually inflation is between 2 to 3%. So that is the benchmark or that is the number that you should try to exceed. And you can see that stocks are definitely the asset class, the type of investments that has beaten inflation by the widest margin compared to other investments. Other investments also managed to beat it, but less. It was less convincing, and you can see that if you just hold cash, it seems that over this period, usually interest rate in banks used to be higher. Now they're not that high anymore, but you were able to earn interest that covered inflation slightly, but essentially it was roughly the same as inflation. So if you held your investments only in cash, you would have not earned anything because your money would be worth the same it was worth when you were starting the investment. So you didn't actually appreciate, you didn't actually multiply its value, you just preserved its value. And that's not really the goal when we're investing. We're trying to beat inflation so that we actually multiply the money, actually make it grow, right? So stocks are an amazing thing and work over very long periods. That also can be seen here. This is an index which includes large companies headquartered in the United States, right? So you might have heard of the index called S&P 500. It essentially, since these companies are often global and whatnot, it essentially represents a big portion of the stock market, right? It contains a lot of stocks, and it can tell us how the value of the stock market as a whole has grown over these years. And I wanted to notice two things. First of all, this is an insanely long period. That's 200 years of data, right? So a lot of years, a lot of data that we have. And you can also see, uh, one note, it's a logarithmic scale. Don't worry about it too much. That just tries to, um, you know, how to say this in simple terms. Normally, things grow exponentially. So, the slope of that growth would be getting higher and higher as the longer you invest. So it would be like right part of a U, or like imagine a J shape that increases more sharply in towards the later years. But this just converts it so that it's not in that shape, but we can see the growth as more constantly. But don't worry about that. The important thing here is to note that the growth is relatively constant. You can see that it wasn't that the stock market grew sharply, in the first 20 years and that did nothing for 100 years. You can see that growth, so increases in the value of stocks, occur in most periods. You can see some periods where it's flat, I don't know if you can see my cursor, but there towards the end, there are a couple of years where it was, not growing, where there were just declines and then trying to catch up on that decline. The same happened here around the year 1924. There you can see a very large decline. That was one of the biggest economic crises in the United States history. So you can see that declines can happen, but also you can see that they mostly grow, right? And for an illustration, on top you can see that $1 invested in this in 1824 would grow to 16 million 200 years later, right? So when you accumulate all those little daily, yearly growths over insanely long periods, such as 200 years, of course that's not feasible for us, but it can generate insane growth numbers. And the total return, so the average return that was earned in 1 year over this data was 8.65%. And that is a number worth remembering because that's usually what you will hear people saying that holding stock markets that holding stock markets earn. It essentially shows that throughout most of the history that is known to us, stock markets usually grew by the average rate of 7 to 9% per year. So that is a realistic assumption of what is expected as growth of the global stock markets. And you can see that this number was relatively stable throughout those years. However, there is a price you pay for this. So there is a lot of growth, right? And a growth that has occurred throughout most of history that is known to us, our capitalist history. But that doesn't mean there are no declines. So this chart shows, again, from okay, that's not 200 years. This is just almost 100 years of data, but it shows that same index. So this is again the value of companies that are headquartered in the United States. And you can see whenever there is this dark blue area, so whenever there is this dark blue line, it was in a decline, right? So the value of these companies declined compared to the previous peak. So if you bought it just in the year 1928, let's say, you could see that you would lose 80% of the value of the investment in the first couple of years, and only then in the later years it would climb back up, right? So declines, and that was an extreme. I don't think such a big crisis is very likely to repeat itself, but it might. But you can see that even in the other years, there are declines. There are declines reaching 50% oftentimes. So whenever you invest, I am telling you that declines, especially if you invest in stocks, declines are guaranteed. They will happen. There is no way to avoid them. They are a reality for every investor, and it's just impossible to avoid them. You can see that they happen way too often on this graph for you to be able to just jump out whenever you think that they will happen, because you never know when they will happen. So you will, if you invest in stocks, experience times when your portfolio will be in red numbers, when you will be in a loss. However, what you can also see here is that they never persist. So whenever this decline happens, remember this graph, eventually you return to growth, right? You just have to wait through it, and that can take months, but it can also take years. So the most important thing when investing in the stock market, so holding many, many stocks, is not to panic and to wait for the crisis to be overcome. So not let emotions stir your decisions, because when your investment declines, you should remember that it's not something that is unusual. It's something that is expected. When I started investing, I was going into it with the mindset that I am going to experience declines and negative returns and be at a loss for a couple of years, maybe as I invest throughout my life. You can even see a quote in the top bottom right corner by Charlie Munger. This is the partner of Warren Buffett, and you have probably heard of Warren Buffett as one of the richest people on this planet, and also probably the most glorified and successful investor of all time. And his partner Charlie Munger invested with him, and they created their company together. And you can see that he's saying that you have to stay calm when market declines of 50%, so losing 50% of your account, wiping it out over a couple of months happen, and you have to react calmly and just sit through it because it is natural. So what we try to illustrate with this quote is that even the greatest investors of all time who have earned insane and unimaginable fortunes by investing realize that this is something that is just the price that you have to pay when you want to invest. This another chart shows that the big conclusion of the previous two slides is that it's best not to respond emotionally and to just buy and hold it throughout most of your life, right? So just invest in stocks and wait for the global economy to grow, wait for new inventions to occur, wait for the society to get more productive, wait for more people to get educated, new tools to be invented, which will all increase the value of stock markets because it will increase the value of all companies because they will be able to generate profits more efficiently. And you will participate on the growth if you hold it for like 20, 30 years. And ideally, you should not even look into that account because it might be in a decline. It will be oftentimes, and that just stirs emotions and leads you away from that growth. This graph in the right shows with the red dots. I really like this graph because the red dots show the maximum decline that occurred throughout that year, right? So, for example, let's say that in January and February, the markets were growing, but then they declined by the amount of the red dot in March, for example. So you can see that that's usually negative, and it's often reaching 20%, many times even 40. But you can see that 5, 10, 20%, that's pretty common. It almost occurs every year. Every year there is some decline, and it's usually 10 to 20%, right? So every year it will happen that you will just lose some euros, some amount from your account sharply over a couple of months because that happens almost every year. However, what the blue bars show, and this is again for the American stocks, for the S&P 500 index, right, that represents many, many stocks. The blue bars show the final return at which the final result with which stocks ended that year. So you can see that although there is decline within that year almost always, most years that decline is overcome, right? That decline is reverted and stocks end in a profit, right? So many times it just happens that from March to June, markets will be declining and going down and everyone will be panicking and it will be a very unpleasant feeling. But then in the second half of the year, it reverts and at the end, there's a profit. Yes, of course, there are some years where the decline persists for a couple of years. You can see them that the blue bars are sometimes negative. So it might happen that stocks will be declining for 3 years. That happened. And that is also something that is already included in that graph where you saw the 200 years of growth, right? So, just the fact that there are declines doesn't mean that stock market growth is gone forever, like some articles will be trying to convince you always. And now, one of the last points, which is also super important, and that is that the longer you invest, the more likely you are to succeed, right? As I said, declines are always short term. Although crises can persist for a couple of years, maybe approaching even 5 to 10, they have always been overcome. So the longer you allow your investments to work and crises to get recovered and humanity to return to growth again, then the more likely you are to succeed. These things represent 10-year average annual returns, right? So that is computed, as the average year in that 10-year period, right? So you have 10 years from when you look to the very left, you can start in 1910 and you hold stocks until 1920, and that is the 10-year average return. You can see that from 1910 to 1920, stocks were declining. So decline can persist for 10 years. However, in most decades, so say from 1940 to 1950 or 1950 to 1960 or 2010 to 2020 at the very right, most decades stocks grew. But you can see that even with 10 years, you can still see the decline after 10 years. However, let's extend this to 20 years. So these are periods of 20 years. That is from 1900 to 1920. It is from 1980 to 2000. It is from 2000 to 2020. You can see that historically, so since 1900, so that is more than 100 and it's 120 years of data, essentially. You can see that there has been no 2-year period, 2-decade period. So if you invested in stocks and held them for 20 years, which when investing for things like retirement, all of us can do, right? If you want to retire at I don't know 65, then you can just start at 45 and you will get 2 decades of investing, right? You can see that all of them were positive. So never in history has it happened for these US stocks that they would end up in a decline after 20 years. And some of those 20-year periods were stronger, some were weaker, but all of them were in profit. But let's now extend it even more, because with lifelong investing, many of us have 3 decades, many of us will have 4. If you start really young, you can even have 5 or 6. So let's extend it to 3 decades, so 30 years. That is, these are 30-year periods. That's investing from 1900 to 1930, 1930 to 1960, and so on. You can see that not only are all of them positive, they are also very stable. They don't differ much. It doesn't matter which 30-year period you choose. They are very close to the 7% figure I told you. 1960 is an exception. That was unlucky. But still, if you held it over those 30 years, you would have earned roughly 5% per year. Which is also important to note is that these are so-called real returns, all of those that you saw here. So they are adjusted for inflation, right? Inflation is subtracted from these returns every year to show whether by how much you actually beat inflation. So, for example, here many of these things are not actually at a super large loss, but inflation pushed them into the loss, right? They failed to cover inflation. But not only here, when you invest for 30 years, are all of those above zero, so you don't lose money. They are also positive, so they are above inflation. They beat inflation, and also beat it by a super wide margin of 5 to 7%. So when you think that inflation is roughly 2%, that gets you to the number we were talking about. That usually stock markets earn 7 to 9% per year. But you have to suffer through all the declines that will happen every year, and you will not avoid them, right? Here is a funny graph which shows that, again, shows why you shouldn't let emotions steer you, because there are always reasons for pessimism. And, as an investor, I know this very well. There are always some people panicking and telling you that the markets are going to fall. So this just shows bad news. Every single piece of text here is some bad news. It's election things, it's natural catastrophes, it's pandemics, things like that. And you can see that there are always bad news. Bad news happen every month. Yet this is the growth of stocks again, and you can see that they keep growing mostly. Yeah, sometimes they decline, but oftentimes, bad news are not a reason for them not to grow. This is because any bad news that gets to you, usually with a delay, is already worked into the prices, and the decline has already happened before, or the bad news are not as bad as we think they are. We tend to overestimate bad news, right? And if we react to these bad news and speculate, that is, we try to sell because we think stock markets are going to decline, but in reality, this will happen, right? So there will be a bad news, you sell. There will be a bad piece of news, you sell, and then the market continues growing despite all expectations. Then you might lose these returns, and it might happen that you will miss the best days. This just shows the final result that you get if you invest for 20 years until the end of 2022 and just missed a couple of good days, right? Because you panicked before them, because you thought one of the bad news from the previous slide was much worse than it actually was. You can see that this sharply reduces your return, right? The worst thing that can happen to an investor is panicking and missing out on growth. And that can cost tens of thousands of dollars, right? As you can see here, or euros, let's say. So it's best not to speculate and just ignore your investments. Just invest and don't do any active decisions for the next years, right? This graph also illustrates it. It's a study that is always conducted by a company called Dalbar that has access to amazing high quality data from accounts of investors. And you can see that an average investor usually doesn't beat the S&P 500, which is just like, holding stocks and not doing anything with them. 60 to 40 and 40 to 60 are those mixed portfolios where you mix bonds with stocks to make it a bit less risky. And you can see that that also takes away a portion of the return, but it declines much less over the years. And you can see that an average investor often doesn't even match the performance of people who don't do anything, who just hold the stocks, right? And that is because emotions lead us to panic, emotions lead us to be overly greedy and to make mistakes. And we also don't have perfect information. So, usually making active choices about an investment leads to mistakes, and mistakes cost money, as you can see in this chart. That is why the notion of passive investing has been developed. Passive investing is just investing in the entire market. So I've shown you a lot of graphs of how when you have many, many stocks, when you hold essentially most of the economy, that the entire market grows because the global economy grows, because we invent new things, because we get more educated over time, because our healthcare gets better and everything like that. We get more productive as a society. So you just buy this entire market and don't do anything. Just buy and hold and do it for 30, 40, 50 years, depending on where you are in your career, or 20 or 15 or things like that. It also doesn't pick specific stocks, so it doesn't try to anticipate, Nvidia will now grow, so I will buy that definitely, and I will ignore the rest of the economy because I know better, because you don't know better. No one has information, and when you're picking stocks, you're going against people who have very good mathematicians and very good information and very fast computers. It's generally very difficult to beat those when you're just investing from home. And that also doesn't speculate on timing, right? So it doesn't sell when you think markets are going to decline. You don't buy when you think they are going to grow, because you accept that it's very difficult to predict those things without making mistakes. Here is a slide that sort of, I told you that passive investing invests in the entire market. But how to do that? How to even do that? How do I invest in the entire market? That's tens of thousands of stocks. Usually, investing in the entire market is done by investing in tools that replicate market indices. An index is essentially an answer to if I asked you how much did the stock market increase yesterday. That is done by taking an index. An index is some sample of companies that represent a large part of the stock market, right? So, for example, let's say that the US stock market consists of 6,000 companies, and an index can be constructed by taking 500 largest. Those account for most sales, for most profits, right? It's easier to track the development of their prices because they are larger, and because there's fewer of them compared to the thousands in the entire US. And that is an index. They will, in general, move. They will rise when the market rises. They will decline when the market declines, right? So if you buy these 500 companies, it's very similar to owning the entire market, right? And the way you can do it, usually, to buy these indices, because it's again it's not easy for you to buy 500 stocks, because often one stock can cost between tens to hundreds of euros. So you would need more than 10,000 euros to buy all of them. So that's when tools such as mutual funds or so-called exchange-traded funds, that is a slightly different tool that we love a lot. We think it's one of the best, comes into play, right? So ETFs are very similar to mutual funds. They hold a lot of stocks, and they usually hold indices, right? So I said S&P 500 largest American companies. There is an ETF that just holds these companies and replicates the performance of that index. So if the index grows by 2%, the ETF also grows by 2%. And they are traded just like normal stocks on stock exchanges. You can buy and sell them at any time. It's just an investment tool. It's an investment tool that gives people cheap and fast access to lots of stocks, to stock indices. Their advantages are, first of all, higher returns, because by holding the index, you eliminate all the emotions that are enemies of investors, right? So, when you hold an ETF, you just hold all the stocks. You don't select which of them you think are better. You don't select which of them you think will rise, and you don't sell those you think that will decline. And that avoids emotions, right? They are also liquid. That just means it's easy to buy and sell them, right? Because they are traded on stock exchanges, you can just sell them this minute and access the money relatively quickly if you need it. They have diversified risk because they hold hundreds, if not thousands, of companies in some of them. That means that if something happens to one of them, you don't suffer, right? You don't lose all your money. If you just hold all your savings in one company, then if something bad happens to that company, God forbid goes bankrupt, you might lose most of your savings. Whereas if you hold hundreds, then you're being more responsible because if something happens to just one of them, you will lose a couple of euros, right? It won't hurt you that much. So you're more covered a bit by that. And they also have very low fees because they don't have all these, expensive managers who decide when the market is going to rise and when it's going to fall, and they use supercomputers and very difficult statistical analysis to do it. They just don't need to have that many fees to cover these computers, to cover these who compute all these things. So they can charge very, very low fees and you don't lose a lot of money on cost of the investment. And in some countries, such as Czechia, Croatia, or Slovakia, if you hold them for at least a couple of years, in Slovakia for 1 year, in Czechia for 3 years, in Croatia, I think it's 2 years, then you don't have to pay taxes on the profit. And that's also a lot of money that would be a guaranteed loss with other tools, and it's not a guaranteed loss with these tools. So that is why we think these are great tools for investing. The last slide before I get to the discussion is the so-called rule of 72. This is a very easy rule which tells you how long it will take to double an investment given some expected return that you earn on it on average as you hold it for years, right? The way you get it is just take the number 72 and divide it by the interest rate or by the return that you get per year, and you will get the result will be the number of years it takes for your savings to double in value with that interest rate or with that return. So you can see that if you just earn 1% interest rate in some savings account, it takes 72 years for an investment to double. If you earn 5%, so take the 5% row, when you divide 72 by 5%, you get the number 14.4, right? So when you manage to increase your return to 5% per year, it already takes 15 years. So do this for 15 years, and you will have double the money that you invested in it. And we can apply this to different types of investments, right? So if you hold cash with 1% interest rate or zero, then it takes 72 years to infinite amount of time, never, for the investment to double. With bonds is a bit better, but it still takes at least 20 years. And with stocks, as we said, 7 to 9%, that is based on 200 years of historical data, growth that usually, happens on the stock markets, but accompanied with many declines and some of those declines for years, you get 7 to 9%. So when you hold stocks your entire life, my best advice is just to make it a habit, right? The way I do it is just I have a fixed percentage of my salary that I want to save, for later, for many years in the future, at least 20, 30. And I just buy some stocks every month. It's just a habit, just like I buy groceries, like I pay for rent every month. I also do this every month. And if you do that for throughout your life, then it is expected. And again, this doesn't have to happen if in the upcoming years a big crisis happens, then it might take a bit longer for your money to double, but then it might, take a bit quicker for that money to double after that crisis hits and after the recovery comes, right? So it depends on the specific decade. In some decades, it can take more than 10 years to double. In some decades, it can take 5 years to double, right? It's not very stable. But if you do this throughout your life, so throughout all the decades, on average, you might be expecting that your money will be doubling approximately every 8 to 10 years. Not like super fast. It's not like, finding your company and earning billions. You won't be a billionaire this way. But it's an amazing way to work with your wealth. It's an amazing way to extract the most of your money for the people you care about, when the kids go to the university in, many years, or if you want to retire comfortably, if you want to support and if you want to be covered by your wealth. So it's a great way to, work with it. So, as I said, first create an emergency fund so that you can stick to investing. Without investing, inflation has eaten away your money. Investing is the way to beat it. The mix between stocks and bond matters. Bonds are suitable for short term because they are less risky. Stocks are suitable for the long term because they grow more if you can afford to wait. ETFs allow you to buy the market. You can't speculate. Okay. I thought it disconnected me. Okay, sorry, because it made this sound as if the meeting was ending. Okay, with that in mind, I wanted to thank you for your attention. That is the end of the slides that I have prepared for you. And I would be happy if right now we could. I see questions. So the way I will do it right now is that I will go through your questions and start answering them. If you have any other questions, just post them through Slido or through chat, or feel free to raise your hand here. Thank you very much for your attention. I hope you learned something. I hope it wasn't too long and too much information to handle. And I hope I inspired you, to think about money a bit differently and maybe research some other things. I definitely recommend, educating yourself about these things and reading a bit more before, jumping straight to it. This was supposed to be an introduction, but I'll be happy if this, evoked interest in learning a bit more about these topics. So thank you for your attention. And now let's get right to the discussion so that we extract the most out of this time. So the first question that I see, by the way, once you will need to run, feel free to tell me, because I know that the meeting was originally scheduled for an hour and a half, but I will try to be quick so that I can actually address your questions. So maybe 10 more minutes, let's say, if that's fine with you. Okay, so the question was, we already covered the mortgage questions, so let's get to the first one that was posted. Would you recommend to have savings in different currencies? If so, do you know WISE, and how would you rate it as a liquidity fund? Fund, yeah. To be fair, when it comes to, I'm now not sure if this is about short-term savings, so having a short-term emergency fund. It's not needed much, I think. I don't know what your baseline currency is, but for example, I personally hold savings only in euro. My emergency fund. Now talking about it, right? It's a bit different when you invest in stocks, because stocks I definitely recommend to own them from different countries. So those stocks will be denominated in different currencies. That is a different story. Definitely stocks from around the world, great. Yeah, that is what we say when we talk about stock markets. However, when it comes to holding things such as an emergency fund in many different currencies, I usually just use my currency, euro, and try to extract the euro interest rates. So that currently is 4%, right? From those savings. The reason I do this is that when I studied finance and when I studied economics, I was reading a couple of studies, and it found that when it comes to the returns of different currencies against each other, right? So one reason might be, one reason for holding different currencies might be that some of those will appreciate compared to your currency. The exchange rate will change in order which will allow you to sort of earn a bit more. So some of them might appreciate and some of them might lose value, right? So I don't know, euro might lose value, and by having other currencies, you diversify that risk, right? When it comes to the return, over the long run, so when you hold this, essentially, you should have an emergency fund throughout your life. The expected returns of currencies against each other are around zero. There is no evidence that some currencies outperform, and are better to hold than others. Yes, some of them appreciate in short run, but usually that reverts back to zero over the next couple of years. So in general, when you read studies about currency returns against each other, they are close to zero. So there's not much sense to do it in terms of earning a higher expected return. When it comes to some risk, I also don't see why this is super important, especially as currencies such as the euro or even currencies of developed countries are unlikely to collapse super sharply. And if that happens, then holding some savings won't holding some savings outside. It's very hard for me to imagine a currency collapse in the eurozone, or something like that. That you would essentially need to hold money in different currencies, and that is for the simple reason that if you hold stocks, right, then you're covered because stocks grow. The problem with currency collapse is that things get expensive, right? If a currency collapses, then it usually means a lot of inflation because things imported from abroad get expensive and companies have to increase their prices to deal with it. But you saw that inflation is being beaten by stocks. So stocks grow more than inflation and they are more capable of beating than inflation. There is more evidence of doing that consistently and throughout the years than other currencies, right? So I can sleep well knowing that if I own a lot of stocks and if I own most of my wealth in stocks, because most of my wealth, except for the emergency fund, is like long term for retirement and similar purposes, then I know I'm covered because I own stocks from around the globe, right? So if one currency collapses, nothing happens to the rest of my portfolio. So to beat that risk of inflation, I just use stocks. And with the rest, there's not much need to hold it abroad. Because, when you hold different currencies, not only can the currency risk work for you, so if that currency appreciates, but if that different currency depreciates in which you hold it, then you lose a lot of money, right? It just makes the investment unnecessarily risky because the value of your money depends on the exchange rate, and exchange rate fluctuate even more than bonds, right? So essentially, by holding different currencies, you will add the risk to the emergency fund, and that is not needed, right? So that is probably the most important point for me, right? I don't want the changes in exchange rates to affect the value of the fund that is there for my emergencies. I want the value of that money to be stable, and that cannot be achieved by going into another currency because necessarily the value of my emergency fund then depends on exchange rate, which is super it is super risky, right? It fluctuates sharply. So I might have 3,000 euros one day and 2,300 euros the next day if I hold it in another currency. And that is just, as I said, emergency fund should be safe. It shouldn't be very risky. So adding currency risk to it doesn't make much sense for me. And then the second part of the question, whether I know the WISE fund, to be fair, I'm not familiar, so I would have to make research on it. So I cannot, I don't want to make rating here because, I not only am I not allowed to make like specific investment recommendations. So be careful about that, right? Like no things that I say here are recommendations of specific funds, specific securities, specific ETFs. That is, that should be based much more on data, on looking, on conducting a longer research about that security. So it would be sort of irresponsible for me to do that off the top of my head. So I'm sorry, but if you want, you can write me an email. It was at the beginning of the presentation. It's pekar slash at pekar at finax.eu, or you can find me on my LinkedIn, Shimon Pekar, and we can chat about it. If you want, I can look into that fund for you. And I know, but I guess that second part of the question is answered by the fact that I wouldn't hold my emergency fund in different currencies. Too much risk, not much return. If you're worried about inflation shocks, stocks do that. Okay. Which country's share market would you recommend for investing? When I was talking about stock markets, I usually said like stock markets as a whole, all countries, to be fair, global. The way we do it and we think is optimal based on data is to hold most of the countries in the world, right? So try to capture the global stock market. That is because you can say that the global economy will grow most likely, right? Because somewhere in the world inventions will appear. Somewhere in the world um, there will be um, increasing educational levels and similar things, right? So some countries in the world will be inventing new medicine and stuff like that, right? So somewhere it will appear, but it's very difficult to find out exactly when. So when I said that global stock market grows, that doesn't mean that every country grows, right? Some countries, such as Japan, have experienced periods when they haven't grown for 20 years because they were struggling for very long. So by holding most of the countries that are in the world, so try to get a global stock market portfolio, you limit this risk inherent to a single country. So for example, even me, I wouldn't recommend to just invest in the US stocks, right? I hold my stocks in many different countries. And the reason is exactly that, first of all, it reduces risk inherent to one country because some crisis can hit just one country. 1997 Asian currency crisis, mainly countries in Southeast Asia affected very sharply. If you held only those countries, that would be very bad. So, to limit the risk, but also to capture the fact that global growth occurs, but occurs in different countries. And only by holding most of them, you can ensure that every invention, every medicine breakthrough, every new school built is, reflected in your portfolio because you hold that part that is currently growing. Would you recommend any other stock index than S&P? There are, many good ones. Depends on the region. So there are either global stock indices that you can look into. So MSCI World, but that's careful. That's just developed markets. Or MSCI All Countries World. Those are global. But then there are, you can split them by regions. So S&P 500, for example, is large US stocks. You have Russell 2000, which are smaller US stocks that contains thousands of stocks, which are smaller. So for example, S&P 500 is just large companies. So you don't get, smaller companies, which can also be great investments, right? They can also generate a lot of growth. They have more room to grow somewhere, right? They can be sometimes more innovative. So that is Russell 2000. In Europe, we have an amazing index, Stoxx 600, that captures large companies from across the EU. There is the MSCI Emerging Markets Index. There is the for Japan, there is one popular index, which is, but that one has a weird methodology. But for example, you have MSCI Japan Index, right, for Japan. So there are different good indices, either global or split by regions, that I in general like, and the main point is that this is not, like a recommendation of a specific tool, but it's important to have most of the globe included. That would be my main idea, right? As that ties to the previous question. So I would look for indices to have a rough representation of all regions in the world, right? And I mentioned some of them, MSCI emerging markets, those are the more developing economies, S&P 500, Stoxx 600, things like that. What do you think about Amundi funds in general? That's a broad question. Depends on the specific fund I get. Amundi has a lot of types of funds, right? Amundi has mutual funds. Because I don't know if this is specifically tied to Slovakia now. They have a like tailored offering in Slovakia or in general, but Amundi does ETFs. Amundi does mutual funds. Amundi does other alternative investment funds. Like Amundi is a giant asset manager. Their offering is infinitely wide. So it's very difficult to generalize something to this because those are different types of products. I would say they can work well. I know Amundi products that I consider good. However, I also know that there are a lot of threats with their products, and specifically with Amundi, I remember doing some things. So check fees always, because some Amundi products, some of their ETFs are super cheap. Some Amundi products, such as mutual funds, are often very, very expensive. They take away a lot of, like several percent of your money every year. And that is bad, right? So whenever you're having a product, and this is a good advice in general, there is always so-called key investor information document or key information document, I think, according to the new regulation. It's under the abbreviation or shortcut KID. Every fund has to publish that. That's if not, that's illegal. So they have to publish that, and there you can find in that document. You can find it on the website always. You can read about the fees. So you scroll down a bit, and there will be a section called "How much will I pay?" or "How much will this cost me?" or something like that. It always has a standard subtitle. And there you can find the breakdown on fees. They will have some entry costs, so those are things that they take away right away from the deposit. There are some ongoing charges. Those are the things that they take every year from the value of your account. And there will be performance fees. Those are the worst ones. Like ideally aim for performance fee of 0%, because performance fee is taken away from your profit, right? So often it can be 10 or 20% of whatever you earn. They just take for themselves. It's like a tax on profit, right? A second tax after many investments are even taxed even themselves, right? So Performance fees, ideally zero. Like whenever that is there, that is a red flag. But also, the ongoing charges, if it's over 2%, if it's like 2, 3, 4%, that is too expensive based on what is on the market. I would say that ideal fee is like somewhere between 0 and 1.5% that I would consider low. Anything above that is like really expensive, and you can find it in KIDs. So fees and having these performance tax fees on profits, all of that is can be a threat. And I've seen Amundi products that have these drawbacks. But again, I saw Amundi products which I hold, right? I have some ETFs that are from Amundi, um, which are cheap, which are great, which replicate their index well. So depends on the product. You should always check the charges. You should always check um, conditions like that, and whether they employ a passive or active approach, right? Um, so yeah, careful about that. But in general, Amundi can have terribly expensive products, but they can also have amazing products that I would I can't make recommendations here and I won't, but there are Amundi funds which I own personally, which I think are good. um, do you recommend to have, except of risky part of investment, some money also in some conservative or less profiting products? Um, da, da, da. Of course, of course. I think conservative investments are good, and um, when? Mainly if you can't afford to invest for very long run goals, right? So um, there are goals which are long run, such as for me, it will be my retirement later on, my family later on, and stuff like that. Things on which I will need to spend in decades. And that is stocks, definitely, right? However, all of us have even financial goals that we need to save up for, and that will be just needed before 10 years. That's just how life goes, right? Some of us might be saving for a deposit payment to mortgage, right? So some own funds that we need to deposit for a mortgage. Some of us are saving for a vacation, right? Some of us might be saving to get a new car, might be saving to have some reserves for when our firstborn child, comes into the family, and we will need to pay more money to start the family, have some expensive of starting a family. So there are many things for which you should save up for, right? I definitely don't recommend borrowing for all these things, because you're gonna get buried in high interest debt and you're never gonna dig yourself out of that hole. So for those goals, I recommend saving up, and you can invest conservatively for those, right? So have some those money market portfolios or bond portfolios or mixed portfolios, right? Stocks mixed with bonds. As I said, I had that one slide where I explained why bonds are added to portfolios. Is precisely when you have a goal that will occur within 10 years. So you can't afford to have all stocks, because stocks can be in declines after 8, 7, 6 years. That can happen. So mixed portfolios between bonds and stocks, or mostly bonds, or money market even for very short-term goals, are great destinations for all of these. I know definitely that I will be saving once I decide that I want to go and purchase, my own housing, my own house. I will definitely save up for that deposit payment in a portfolio that will consist mostly of bonds, or at least half of it will be bonds. So conservative investments and investing even for shorter term, for 5, 4, 6 years, is a great thing. I definitely think so. And for any goals which will occur in less than 10 years, having some conservative, less profitable, right? You won't earn as much as on stocks in 30 years, but less profitable things is super reasonable. And yeah, so I think that bonds definitely, just because they earn a bit less, or okay, not a bit, but just because bonds earn less than stocks, or conservative money market investments earn less than stocks, that doesn't mean that they are useless. They are useful because of their non-riskiness, right? They can be used for things that are shorter term. So so yeah, or even these investments can be useful for that portion of your emergency fund, so you can hold a portion of your emergency fund in a high interest savings account where it's accessible immediately, but you can hold the second half of it in a mixed portfolio, right? So that you manage to beat inflation with that. So all these things, these tools definitely have a great role in an investor's life. Okay, are there any more questions? Oh, thank you. I see I see the shout out that has been voted up in the slide of questions. Thank you very much. I really appreciate it. I hope it wasn't too complicated because these topics, it's always difficult to explain them in simple terms, because a lot of math and statistics. Like, who wants to hear about that? It's like it's difficult. So I hope that I managed to simplify it enough, and that I managed to evoke interest. So thank you very much. If you like this presentation, then I will be happy if you give us as Finax, or give me personally as Shimon, a good reference, either with your HR or with us later on when there will be a survey about this, because we're looking to find out how satisfied people are, and maybe we'll even see each other at some of our other topics. As I said, we have these presentations ready also for budgeting and financial planning and personal finance basics, and also for retirement specifically. That one is more focused on specific retirement products, because those work different from general investing. They have tax advantages and stuff like that. So, maybe we'll see some of you also on those presentations if they happen at some point. So thank you very much. Thank you very much. I really appreciate it, and I hope you all liked the presentation. Oh, there are new questions. Ooh, new questions. Okay, so new questions. How would you recommend investing a bigger amount of money, e.g., into index, in one amount or split it in separate parts? A great question. Great question. We receive it very often. So let me first of all explain for the others the general rationale, right? Let's say you have a large amount of money. Let's say you have 10,000 euros and you want to invest it because you want to appreciate it and everything. However, you run a sort of a risk that, let's say that you're at a point where the market will grow for 2 months and then decline sharply, and then keep being somewhere in decline for 2 years, and then starting to grow again, right? If you buy it at that top, so right before it declines, you will not only be at a loss for a couple of years, that is expected, but you sort of bought it for an expensive price, right? If you waited for a couple more months, you could have gotten a cheaper price, and that would mean that your final result would definitely be better because you bought in more profitably, right? So that is the the rationale behind it. Whereas if you split it, right? So let's say you have 10,000 euros and you split it into 10 parts. You have 1,000, 1,000, 1,000, 10 times, right? And you invest every 1,000 every month, right? So the first 1,000 I will invest today. The second 1,000 I will invest in 1 month. The third 1,000 I will invest in 2 months. The third in 3 months, and so on until I have invested the full 10,000. Then if a market declines suddenly, then if the market declines suddenly, you will have bought only a portion of your money for that expensive price, and then the rest you bought at cheaper prices, right? So your average price at which you bought the portfolio is a bit more beneficial, right? It's a bit cheaper than if you bought everything at those expensive prices, because you also bought some of those 1,000s for a cheaper price, right? This is called the dollar cost averaging, because you average out the cost of the portfolio, right? The reason I don't usually recommend this is as follows. It has two drawbacks, right? You should choose your portfolio based on how long you can invest for, right? So if you can afford to invest those 10,000s for 20 or 30 years, then the exact price at which you buy it doesn't matter much, because think about it this way. I was also thinking about this, right, recently, and in 20 years, if we account for the average stock market growth of 7 to 9% a year, right? That one that I showed you on the historical graph. Let's take the example of an S&P 500 index, right? It's right now around 5,000, right? If we apply that growth, that 7 to 9%, me personally, I will probably see 30 to 40,000 levels in my life, right? Later on when I'm older, when I'm withdrawing and using my wealth. but I will probably see those levels. And back then, when I'm in those 20, 30 years and I'm looking at 35,000 on S&P 500, I would feel kind of silly that I was so stressed about whether I buy it for 5,000 or whether I buy it for 4,500 or 4,000. Like it's such a small of a difference compared to all those returns that you can earn over years that it doesn't really matter, right? Um, and the second part of this fact is that over the long run, stock markets grow more than they decline, right? So it's always more likely that in the next year stock market will grow than that it will decline. I don't know the exact percentages, but it's slightly in favor of growth years, right? So it's more likely when you split, into 1000s, that you will actually end up increasing your price than decreasing it, right? So um, because this splitting out the investment can also turn out against you, right? If the markets rise sharply, you could have bought cheaply at the beginning, but you bought more expensively because you deferred some of that investment into later years when the investment was already more expensive, right? So um, so you lost money essentially on it. You made your investment more expensive, and this scenario is a bit more likely based on historical data than the fact that you would save money on it. So you know what we usually say is that if you invest for 20 years, statistically, it's usually worth it to invest right now because stock markets grow in the long run, and it's more likely that if you defer investing, you will buy in at higher levels than that you will manage to buy in at lower levels. Yes, this involves risk, and I have in my life already recommended this to people, and many of my very close friends happened to invest on top, right? So my advice, although statistically like probable, turned out bad, right? They went into a decline, and they had to suffer through the decline. But right now it doesn't matter much anymore because they were in red numbers for 2 years and they were annoying me with that every month, like texting that I'm stupid. But then the markets recovered suddenly, and now they're all in profits. And uh, that's like we always view it very sensitively for the first 5 years. But if you stick to it, then actually, like you actually can manage to invest for 20 years, the difference won't be as large. However, there is one last point I would like to make here, and that is the fact that if this strategy, and that is the like worst thing that can happen, if this strategy of splitting investments, works against you. So let's say you start buying and the stock markets rise sharply, and now you are buying it at larger prices, and you could have done better by investing at a cheaper price. Um, you may start to speculate. You will be feeling bad that oh shit, I split it and I could have invested for a better price. And you might start speculating. You might be okay, so now they rose, so it's more likely that they will decline now again, right? So let's hold on to these 1000s, and let's not invest them for like 3 months, not 1 month interval, but like 3 or 4 months, because the stock markets will decline. And if they don't, and if they rise again, which can happen, even more, you'll be like, okay, now they have to decline, and you will start owning the investment in your hope that the stock markets would decline, meaning that you will maybe defer your investing by years or maybe not invest it ever, right? And that is the worst that can happen because, if you defer investing by years, you saw on that graph that makes all the more likely that you will, lose out on growth because only invested money can capture growth of the stock markets, right? So if this happens, that is the worst case. However, in principle, as I said, because in 20 years, the levels will be very, very different and much higher probably than today. Um, Even splitting the investment won't make such a difference, right? So even if it turns out against you, or even if it's roughly the same as investing it at the beginning, it won't be such a difference. So if you would feel more comfortable, if you really don't want to to have that risk that what happened to my friends will happen to you, that you will be looking at deep red numbers for the first 2 years. And if you just couldn't live with that, which I don't recommend because we should get used to declines, but then you can split it. Just like split it. Nothing bad will happen. Like it's not that this choice is super substantial, right? That what is most important is to get the money on the market within a couple of months. That is that is the most important thing. As long as you get it there and hold it for the subsequent 19 or 20 years or whatever, like many years, then it's good. Then you've made no mistake. So my advice: do whichever feels psychologically more comfortable to, like, make you invest all that money, and then just hold it, and don't ever regret any, timing or anything. That would be good. So yeah, so that would be my advice. I would personally go for one off, but don't worry if you split it, if that's what you feel comfortable at. If that's what will force you to invest, then do it. It's not such a huge problem. As I said, the worst thing that could happen is that you defer investing by years or don't invest it ever because you're too overthinking this not unimportant decision too much. Okay, the last thing. Oh, thank you. I'm really grateful that it's or I'm really happy that it was also understandable for people, who don't have a strong knowledge basis in this. That was the goal. That's how we try to do this education, because you know who has a degree in this or 10 years of experience doesn't need to hear about these things. We try to get it to people who can benefit from investing hugely and could access it, but they didn't have people um, to explain it in a way that is accessible and doesn't involve, like, too much professional talk and everything. So we're happy that it is that this goal is actually has been achieved today. Okay, it's 12, so I won't hold you much longer, so that you can go enjoy your lunch. I'm also going to. Thank you very much for sticking with me until the end of this Q&A session. If you have any other questions, feel free. Okay, wait, I will now stop recording.